Hey everybody, it's Mike over at Taxes and Bricks. Welcome to episode 70. Today is Mailbag Friday. And I just had one question that came in that I haven't answered really before. And it's in reference to work-related 401ks. And there were sort of two questions. I have a client who is being allowed to participate now in work-related 401k, employer-provided retirement, and they had a couple of questions, so I'm going to run through those two questions they had. But first, because this is tax-related, I'm going to throw up the quick disclaimer that we all have known to come to know and love and crave. Can't live without the disclaimer, so stand by for that, and we'll be right back.
This video is rated TAX and contains occasional ramblings, mild attempts at humor, self-deprecation, irreverence, brief numerical examples, and adult tax and accounting advice that may not be suitable for all taxpayers. Viewer discretion is advised. Before following any of the advice in this or any of our videos, you should always consult with a tax professional. Thank you.
All right, so give you a little background here. Client reached out to me this week. They started a new job a while back, and this employer did not have 401k, but recently the employer opened up a 401k plan and sent a bunch of materials to the employees, which may as well have been printed in Greek for all the good that it did, because these documents tend to be pretty confusing. And after explaining a few things to this client over the phone, the two questions that they had remaining was, what are the benefits of participating in the 401k plan at work? And they were offered the option of doing either Roth 401k contributions or regular / pre-tax traditional 401k contributions, or a mix of the two, and they wanted to know what they should pick. So I'm going to address the first question first. And to give you a little background, a 401k is what's known as a qualified retirement plan. What makes it qualified? Well, it's a qualified retirement plan in the sense that it follows certain rules and prescribes to certain standards related to the federal and some state government regulations. They're heavily regulated. Typically, the 401k plans through employers and even private 401k plans that you might open up if you're a self-employed individual have to go through certain compliance testing. There has to be government filings associated with them. Most of the time, actually all the time, if you work for an employer, you don't really have to worry about all that compliance stuff. You just kind of opt in for what you want to do. So the 401k plan, as a qualified retirement plan, allows you as the employee of a company to contribute out of your paycheck a certain amount of money, or a certain percentage of your paycheck, every time you get paid and throughout the course of the year. And typically there's a limit as to how much you can contribute. So for 2022, the limit that you're allowed to put into the 401k plan is $20,500 if you are under the age of 50. And if you are over the age of 50, I believe you can put in an extra $6,000, might be $5,000, I don't remember. These numbers change all the time, but you can put in a little extra as a step-up contribution, or as a catch-up contribution, not step-up contribution, catch-up contribution. Once you're over the age of 50, this client is not. This client is actually in their early 40s. So I told them they can put in up to $20,500. So what does that do for them? Well, if you opt for the pre-tax option, which is what I'm talking about right now, what that does is that takes your W-2 income down. It subtracts from your W-2 income by however much you place into the 401k. And thus, that means you're reporting less income on your tax return, and thus your taxes are lower. So this creates a tax deduction, okay, and thus a tax savings for money that you basically get to keep, okay? That money gets placed in the 401k. If you have an employer that does matching or profit sharing, then you're once or twice or a couple times a year, your employer might also put in a certain amount of money based on your salary or based on your contributions or based on the profits in the company, whatever the arrangement might be. And that money sits and it's there for your retirement, and you add to it year after year. And whoever's managing the 401k should be investing that money. and helping it grow. In an ideal world, they help it grow. And then from there, once you are retired or you need to tap the money to supplement your sort of fixed income retirement or something like that, you're able to draw off of that 401k. If you are deducting the money on the way in, and this is where we start to get into the Roth versus regular. So talking about a regular contribution to a 401k, you're deducting that money. Remember we said your W-2 is lower, so that's a deduction and a reduction immediately in your taxes. When you pull the money out in retirement, or any time really, it's subject to income tax, and that's including the amounts that you put in, plus any interest, dividends, capital gains, or growth that you might have experienced. So it's pre-taxed on the way in, so it's tax deductible, and then it's taxable on the way out. Okay, subject to federal income tax and income tax in the state where you're living when you make that distribution as a resident. Okay, so this leads to the second question, which is whether or not to do Roth versus regular and what the difference is. Well, we've already been through what a regular contribution is. So now we're going to talk about Roth. Roth contributions, the limits are still the same. It's $20,500 that you can put in, but you don't get a short-term subtraction. So if you put in $20,500 and you make $100,000 a year, and that $20,500 was Roth contribution, your W-2 is going to show $100,000. If it was pre-tax, your W-2 is going to show $79,500 as income. So you can see the difference. Your W-2 is much lower if you go pre-tax. It's higher if you go Roth. The benefit of Roth, however, is the money goes in, you pay your taxes on it now, and then when you pull that money out, including earnings, it's tax-free in retirement. Okay, so one of them is tax deductible now and taxable later when you pull it out. Now it's taxable for Roth and it's tax-free later when you pull it out. Okay, so which one do you pick? I'm going to give you a very simple answer. I don't know. Okay, because you are like a precious fingerprint or a snowflake. You are different. We are all different. There are no two people alike, just like there are no two fingerprints and no two snowflakes alike, okay? And when it comes to retirement, you might have very different goals and very different future fate and destinies than I do. And so if I were to say, well, this is what I do, that may not hold true for you. And this was the conversation that I had with them. You have to make a decision. And typically we do this in conjunction with talking to a financial advisor, a certified financial planner, as to which option is best for you if you're going to go one or the other, or whether or not you want to go with a mixture, okay? Whether you want to hedge your bets. Why? Well, if you think about it, if you're going to be one of those people that's in a really low tax bracket when you retire, but you're in a really high tax bracket when you're working, you want the deductions when you're in a high tax bracket, and you'd rather pay the taxes when you're in a low tax bracket. If you're in the reverse, where you think that you're maybe paying less in taxes now than you are in terms of percentages when you retire, then maybe Roth is the better option. But does anybody really know the answer to that question? I mean, unless your name is like, I don't know, Zuckerberg or Musk or Buffett. Well, Buffett's probably already basically retired, but any one of these bajillionaires, they probably know that later on in retirement, they're probably going to be in a higher tax bracket than they are now, because these are people whose wealth just continues to rise. But you and I, we're average people. We don't know. We have no idea what the future is going to hold for us. And so for you, you may want to hedge your bets. You may want to participate in both the pre-tax and the Roth at work. Maybe you want to do pre-tax only at work and then try and figure out a way to privately fund Roth. When I talk to a lot of financial advisors, their response to me is always sort of the, kind of the assortment theory, where essentially you kind of want to pick from a lot of different flavors and hedge your bets. You put your eggs in one basket unless you're absolutely certain, and I don't think there are a lot of people who are. You're liable to get burned. So I don't have an answer. That's the simple answer. I don't know whether or not Roth or traditional is the best option for you. And you should consult with a financial planner if that's a question that you have. I personally do a mixture of both because I don't know in retirement whether I'm going to be in a higher or lower tax bracket. Also, too, I like the concept of Roth because typically with Roth, you don't have required distributions when you hit 72 years old like you do with regular retirement. So something to consider there if you're putting all your eggs in one basket in sort of that pre-tax model. Once you hit 72, which is the current age for being required to take money out of your retirement accounts and pay taxes on it, you're going to be required to pay taxes on your retirement accounts at that point. Roth, you got a little flexibility. You can kind of maybe wait a little longer after 72 to start tapping that money. Nobody can ever force you to. There's also an inheritance component to this, and I say this because I think it's important. If I were to pass away today and leave my heirs all of these pre-tax traditional retirement accounts, they're going to get them, and it's assuming it's not my spouse. Let's say it's my kids or a niece or nephew or something like that. Those non-spousal heirs are going to be required to liquidate any pre-tax retirement like 401k or traditional IRA or other types of pre-tax retirement within 10 years of receiving it. And that doesn't seem like a big deal. Oh, a big deal. Well, yeah, I see situations where this actually causes a pretty significant financial hardship because the heir who gets it, maybe they get it and they're in a pretty high tax bracket already. Maybe they would rather have the flexibility as to when and whether to take that money and distribute it out. With Roth, what's kind of nice about that situation is even if they did have a time limit to distribute all of Roth IRA money or Roth 401k money to themselves after inheriting it, there's no tax implications because it's Roth, okay, to them. Whereas they got to pay taxes when they inherit traditional sort of pre-tax deductible retirement accounts. So anyway, just a concern. I mean, I don't sit around and spend my days concerned about what's going to be happening when I'm gone because I'm still upright and I'm still ready to enjoy my life and still ready to, work a whole lot longer and play a whole lot longer and have some fun. But if you're looking at, finances in a holistic way, then there is a concern in terms of what happens when you're gone estate-wise. So something just to kind of consider and all that. That's it for today's mailbag. I am really hoping I'm going to have 1 or 2 sets ready for next week, Lego sets. I think Back to the Future, the DeLorean's going to be ready. I'm through bag 5 at this point. And there's, I think, 6 more bags left. I think I can get them done over the weekend and Monday holiday. And then Spring Lantern Festival, I'm hoping to have done next week as well. I just need to find the time to do that because I'm building that at the office and I don't really do much building at the office, maybe 15 minutes here and there. So anyway, thanks for watching. Have a great weekend. And we will probably be back Tuesday with the Monday holiday. I will probably not be recording a video. Also, my sister and nephew are coming to town, so I'll probably be busy this weekend doing stuff with them, trying to hit up the zoo, maybe a swimming pool. Although last time I was at a swimming pool and I took my shirt off, Greenpeace showed up and tried to shove me back in the ocean because I look like a beached whale. But anyway, we won't get into that. Love you guys. Have a great weekend. Thanks for watching. Don't forget to like, subscribe, and have a great day.